Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go. The breakdown of the Bretton Woods system on August 15, 1971, and the adoption of the regime of the freely floating exchange rates generated an increasing interest in the examination of the relationship between currency exchange rate movements and economic parameters such as supply, demand, interest rates, economic growth, inflation rates, and other macroeconomic fundamentals. The relationship between economic parameters and exchange rates has been one of the most controversial issues in international economics and a long-standing puzzle. On the first hand, Mies and Rogoff, 1983, are the first who show that it is virtually impossible to explain or predict nominal exchange rates using standard macroeconomic models and fundamental variables to short-term periods, though they find that accuracy generally increases at longer periods and demonstrate that a variety of linear structural exchange rate models fail to forecast more accurately than a naive random walk model. Frankel and Rose, 1995, conclude with doubts about the value of further time series modeling of exchange rates at high or medium frequencies using macroeconomic models and summarize the various difficulties in empirically relating exchange rate behavior to shocks in macroeconomic fundamentals. Moreover, empirical evidence in favor of predictive ability of macroeconomic fundamentals has been mainly found at longer horizons. Chung, Chin, and Pasquale, 2005, conclude that models with macroeconomic fundamentals cannot outperform the random walk and only models with Taylor rule fundamentals can have some predictive merit. The primary goal of this empirical paper is to examine, for the first time, the predictive ability of gold prices for the nominal/real exchange rate of the Australian dollar with respect to the US dollar. The fluctuations of gold prices are crucial for the value of the AU dollar. This is because once foreign exchange traders know whether this commodity is strongly correlated with the production and export potential characteristics, they can better predict how gold prices could affect the exchange rate. Our empirical findings suggest that we find a strong systematic relation between gold prices and the exchange rate. In other words, we conjecture that the mechanism leading to these results is the fact that, for an open economy exporting gold, the exchange rate should reflect fluctuations in gold prices. Our empirical work is closely related to the literature on using commodity prices to predict exchange rates. Chen, Rogoff, and Rossi, 2010, provide evidence in favor of the fact that the out-of-sample predictive ability of commodity prices for nominal exchange rates is minimal, while Chen and Rogoff, 2003, consider commodity price indices and find in-sample empirical evidence for predicting real exchange rates. Beckman and Chittage, 2013, investigate the association between oil and effective dollar prices through a nonlinear adjustment model, and they document causality runs from exchange rates to oil prices, and not vice versa. In terms of volatility transmissions, Hamada, Yuan, McAleer, and Thompson, 2010, show how the conditional volatility of a number of precious metals, including gold, affects the volatility of the US dollar to euro exchange rate, with their results documenting that there exist interdependencies between the volatility coming from the previous metal price and the relevant exchange rate. Finally, Ewing and Malik, 2013, also find strong evidence of a strong volatility transmission mechanism between gold and oil future prices, supporting cross-market hedging strategies and sharing common information sets across markets. For Canada, Australia, and New Zealand, countries that depend heavily on their commodity exports, the world price of commodities appears to have a strong and systematic relationship to their currencies. Chen, 2004, extends His work to look at commodity price augmented monetary models for nominal exchange rate determination and out-of-sample forecasts. He finds that the inclusion of a commodity price term can improve the forecast performance of these standard models dramatically. It has long been observed that there is a close relationship between the price of some primary commodities such as gold, oil, agricultural products, and certain currencies, described as commodity currencies, with a large share of production and exports accounted by primary commodity products as the ones described before. The main idea behind commodity currencies is that the value of a commodity currency usually rises and falls in relation with the value of the country's main commodity exports. Both the value of a commodity and the country's trade balance, with respect to the commodity, are significant factors in the valuation of commodity currencies. The most commonly traded commodity currencies are those of the Canadian dollar, the New Zealand dollar, and the Australian dollar. These three countries are highly integrated into global capital markets and are active participants in international trade. Since 1983, the Australian dollar, AUD, has been floated, while core reforms, i.e. the development of an active local bond market and a non-deliverable forward currency market, led to the internationalization of the currency and to a substantial rising of the living standards of Australians. This regime allowed the economy to absorb such shocks without the inflation changes that characterized the previous managed floating regime. Today the AUD is the sixth most traded currency globally, while the exchange rate between the AUD and the USD is the fourth most traded currency pair. Commodity terms of trade have recently attracted renewed interest due to their wild fluctuations. Indeed, commodity prices are generally found to drive exchange rate fluctuations in commodity exporting countries, and econometric models of equilibrium exchange rates often include this series among their explanatory variables. It has been also contended that movements in Australia's exchange rate are influenced substantially by changes in its terms of trade. This view has been corroborated by the work of Blundell-Whitnell and Gregory, 1990, and Gruen and Wilkinson, 1994, who establish a long-run relationship between Australia's exchange rate and its terms of trade. This should be of interest to all those countries whose currencies seem to be susceptible to terms of trade shocks. The list of such countries includes not only small, open, commodity exporting countries like Australia, Canada, and New Zealand, whose terms of trade are shocked positively by rises in international commodity prices, but also the USA, Japan, and Germany, whose terms of trade are shocked negatively by rises in international oil prices. Australia is a major exporter of mining and agricultural commodities, and it has long been observed that there is a close relationship between commodity prices and the AUD. According to commodity prices, at least in the medium term, affect the value of the AUD due to Australia's dependence on mining and farming exports. When the world price of commodities rises, the AUD tends to appreciate and vice versa. Gruen and Wilkinson, 1994, argue that the terms of trade are a fundamental determinant of the real exchange rate for a commodity exporting country like Australia, following the long literature that has studied the impact of exchange rate volatility and exchange rate regimes on trade flows. Sercu and Uppel, 1999, conclude that even in a very simple model, it is possible to have either a negative or a positive relation between trade and exchange rate volatility, depending on the source underlying the increase in exchange rate volatility. Moreover, Chin et al., 2010, support that price fluctuations in world commodity markets represent exogenous terms of trade shocks that impact a significant share of their country exports. After coal, iron ore, and crude petroleum, gold currently ranks fourth in value of all Australia's merchandise exports. There is perhaps no other industrial endeavour that has had such a profound effect on the Australian nation as gold economically and socially. Australia has had a productive and vibrant gold industry for over 150 years, while the extent of economic gold resources has always been a difficult issue to quantify. Therefore, the fluctuations of international prices of gold are extremely crucial for the value of the AUD. The increase in world gold prices to more than $500 an ounce by the early 1980s and the widespread acceptance of exploration techniques led to a rapid increase in gold production. It is true that gold in many cases characterized and as safe haven for investors seeking protection from falling stock prices. In other words, the presence of gold is likely to enhance the stability and resiliency of the financial system because it dampens negative shocks falling on various assets through the gains obtained by gold that functions as a safe haven. But gold has historically been more than just a safe haven. It also played a vital role in the monetary system as real money. The demand for gold has recently surged as investors have turned to the precious metal to protect against global uncertainty and as a way to hedge against inflationary concerns. The metal's price is up a stunning 619%, 2011, since its low in 1999, while the S&P 500 index is down 16%. Therefore, the fluctuation of international gold price is crucial for the value of the Australian dollar. To get some insight into the trend between the two variables under study, we plot daily gold prices and the AU dollar/US dollar exchange rate. There is clear evidence of a substantial importance of gold prices for the course of the AU dollar/US dollar exchange rate. In other words, the surge in gold prices appears to be associated with the exchange rate. Our research will test empirically the validity of this hypothesis. This paper contributes to the relevant literature by focusing on investigating, for the first time, the dynamic relationship between nominal and real exchange rate changes and gold prices in Australia. According to Chen and Raghav, 2003, the empirical results are expected to offer potential insight to the policymakers on the grounds that there is great concern in the literature about whether policymakers in small open economies should respond to exchange rate movements when setting monetary policy. Brachetto and Voss, 1999, Dungy and Pagan, 2002, foreign exchange traders, hedge fund managers and international portfolio managers could potentially benefit in cases where trading among currencies requires the examination of the relationships between different markets to capitalize on the opportunity. The results indicate that the EC model that includes gold prices performs better than the benchmark random walk model. In other words, the results speak clearly for the inclusion of information on gold prices when forecasting the Australian dollar/US dollar exchange rate, while the results remain robust across forecasting horizons. This paper provided evidence that gold prices do matter in forecasting the Australian dollar/US dollar exchange rate, with daily and monthly data for nominal and real exchange rates, respectively. The results showed that gold price information improves AU dollar/US dollar exchange rate forecasts significantly vis-a-vis the random walk behavior. These empirical findings are extremely important in terms of information availability for gold exporters, monetary policymakers, hedge fund managers, and international portfolio managers. Nevertheless, our results do not exclude that other channels may also be at work, such as demand shifts owing to monetary policy and asset or currency markets. Our results could have potential policy implications, given the vulnerability of gold prices to monetary shocks. Should monetary policy rules explicitly include gold prices volatility? To what extent is stable gold prices a prerequisite for stable exchange rates, e.g. for a stable US or an AU dollar? Which effect would a hard landing scenario of gold prices have on the exchange rate under study? Future research efforts could proceed in certain directions. For instance, a future empirical effort on a panel basis, i.e. with more countries characterized as gold exporters, could give a better perspective on the results that incorporate panel co-integration and panel error correction. In addition, future research should concentrate on exploring nonlinearity and asymmetries in the relevant relation. Finally, making an explicit distinction between supply and demand shocks may also shed a light on the nature of the relationship. Gold prices and the Australian dollar, AUD, are often positively correlated, meaning that they tend to move in the same direction. This is because Australia is one of the world's largest gold producers, and gold is one of Australia's largest exports. However, while there is a correlation between gold prices and the AUD, it is important to note that correlation does not necessarily imply causation. In other words, just because gold prices and the AUD tend to move in the same direction, it does not mean that one is causing the other to move. In addition, there are many other factors that can influence the value of the AUD, such as interest rates, economic growth, and political developments. Therefore, while gold prices can be one factor to consider when forecasting the movements of the AUD, they should not be relied on exclusively. Overall, while there may be some relationship between gold prices and the movements of the AUD, it is important to consider a range of factors when trying to predict the future movements of any currency. To explain in practical terms, let's consider an example. Suppose that gold prices rise due to increasing demand from investors who are seeking a safe haven investment during times of economic uncertainty. As a result, the price of gold in Australian dollars also increases. This increase in the price of gold can have a positive impact on the Australian economy because Australia is one of the world's largest gold producers. An increase in the price of gold can lead to increased profits for Australian gold mining companies, which can in turn lead to increased tax revenue for the Australian government. This can have a ripple effect on the value of the Australian dollar. As the Australian economy strengthens, demand for the Australian dollar can increase, leading to an appreciation in its value. However, it is important to note that there are many other factors that can influence the value of the Australian dollar, such as interest rates and economic indicators like GDP and inflation. Therefore, while gold prices may have some impact on the value of the Australian dollar, it should be considered as just one of many factors that can affect currency movements. Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.